Every headline right now is screaming that the housing market's crashing. 10 markets just lost $233 billion. Sounds terrifying, right? But here's the truth. While those markets dipped, nationwide housing wealth just hit a record $55 trillion. Yes, trillion. Even California, after losing $106 billion, is still up 46% from pre-pandemic levels. And Florida, still soaring up 76% since 2020. So no, this isn't a crash story. It's a rebalancing story. And I'm about to break it down for you without all the hype. I'm Lily Vallario, an award-winning realtor here in Maryland. I've been selling homes for 21 years. And in this channel, you'll get only straight, no-fluff real estate advice that you can use in any market, no matter where you live. If you're new here, please hit that subscribe button. I'm on a mission to reach 2,000 subscribers, and every single one counts. You've probably seen the talk about massive housing losses, and maybe you're starting to worry about your home's value. The truth, those scary numbers are mostly clickbait. Yes, San Francisco lost $52 billion. Dallas dropped $37 billion. Miami fell $25 billion. Sounds terrifying until you understand the context. 7 of the 10 biggest losers were in the South, 4 of them in Florida alone. That's not random, it's a pattern. These were the hottest pandemic boom markets, and they're cooling the fastest. Here's why. Prices shot up way beyond what local incomes could support. Mortgage rates jumped, slashing buying power. And people who rushed into these places like Miami and Dallas started leaving just as quickly. Think of it like a rubber band stretched too far. It had to snap back. These markets aren't collapsing, they're normalizing. That $233 billion in losses, it's not a meltdown, it's a market correction. Just like a pressure valve releasing steam, prices are adjusting to sustainable levels. And here's the real story. While those 10 markets were cooling, other areas were gaining even more. Let's take a look. The part nobody's talking about. The gains. The top 10 gaining markets added over $484 billion in the same time period. That's more than double the so-called losses everyone's panicking about. Take New York City, for example. It gained $260 billion. That's 5 times San Francisco's $52 billion drop. One city's growth alone completely erased multiple cities' losses. Think of the market like a deck of cards. The pandemic stacked certain piles too high, and now the deck's being reshuffled toward places with better value. The Midwest and Northeast led the way. Seattle was the one Western outlier thanks to a strong tech industry and diverse economy. While other West Coast cities cooled, Seattle stayed steady. Tell me in the comments, are you in one of those growth markets or are you seeing the opposite where you live? Drop your city below. I love seeing where everyone's tuning in from. And if this breakdown is clicking with you, go ahead and hit that like button. Here's the real story. The U.S. didn't lose housing wealth. It shifted. I just mentioned national wealth just hit a record of $55 trillion. Money didn't vanish. It moved from overheated markets into stable, affordable ones with solid job growth. And that shift is where the opportunities are. Markets with steady demand, healthy job bases, and prices that match local incomes are the ones attracting buyers and investment. And when we zoom in state by state, the picture gets even clearer. California still holds $10.8 trillion in housing value. Even after losing $106 billion, that's still 46% higher than pre-pandemic levels. California alone controls nearly 20% of all U.S. housing wealth. Florida sits at $3.7 trillion, up 76% since 2020, even though it had the 4 of the biggest loser cities. New York State is at $4.3 trillion, up 52% since the pandemic. These aren't falling markets. They're markets that just grew so fast they needed to catch their breath. So what about Maryland? Here's what I'm seeing. We're not one of those overheated boom and bust markets. Yes, higher rates are squeezing buyers and sellers are feeling it too, but homes here are still getting reasonable offers when they're priced right. Inventory is low in many areas, which is keeping prices supported. That's why Maryland hasn't seen the dramatic dips you read about in places like Miami or San Francisco. We're not immune, but we're stable. It's not a frenzy. It's not a collapse. It's a steady, balanced market. So the question becomes, should you let national panic headlines drive your real estate decisions, or should you focus on what's happening right in your neighborhood? For buyers, here's what matters most. Count the active listings in your target neighborhoods. Look at recent closed sales in your price range and check how long similar homes are staying on the market. For sellers, here's your playbook. Price based on recent comparable sales nearby. Stage and update your property so it stands out. And track your local buyer activity and adjust based on what's happening in your area. Picture selling a car. Shine it up, price it fairly, and it's gone in a flash. Overprice it or ignore the issues, and it just sits on the lot. Here's your market checklist. Active listings, recent sales, days on market, that's your real market intelligence. And here's the truth. Local supply and demand always beat national headlines. Limited inventory is still giving sellers leverage, but buyers are getting more selective, which means presentation and pricing matter more than ever. So here's the bottom line. Losses are concentrated in just a few overheated cities. National housing wealth is at a record of $55 trillion. And the data that matters most, it's what's happening in your neighborhood. Check your inventory levels, days on market, and local employment trends. Those three things will guide your decisions way more than any national headline. If you're here in Maryland and want a personalized market breakdown, my contact information is in the description box below. And if this video helped clear things up just a little bit, please hit that like button and subscribe. I'm on a mission to reach 2,000 subscribers, and your help will help me get there. And before you leave, please tell me one thing in the comments. Do you see these declines as a healthy correction or a warning sign? Thanks again for staying until the end, guys. I'll see you in the next one. Bye.